Just pop on the live so we can get that recorded.
It does feel like a groundhog day for me.
Sorry to hear you're not feeling good again, man.
It's been a constant thing. I don't know if it's
Yeah, I was
COVID or
gonna say,
not,
I feel
but
like you were
it's
sick
just,
the last
it
time
is
we
cold and
talked
flu
too.
season, as Bill Murray tends to remind us in Groundhog Day. So
Yeah,
it does feel like a
Yep.
groundhog day for me. Every week or so I feel better, and then I feel sick again. So.
Yeah, I was gonna say I feel like you were sick the last time we talked too.
Yeah, it's the
Yeah,
same
so I
thing.
want to get
It
that
just
checked in,
it
but I
won't
mean, at the
be,
same time,
so it
what can
could
they
be
really
long
do for
COVID.
you
I don't
for it?
know. I should bother. At some point, I should go get tested. But basically, from everything I can tell, it is matching the symptoms. So.
Yeah, I want to get that checked in, but I mean at the same time, what can they really do for you
That's
for
the
it?
point. It's like, well,
Yeah, exactly.
just tell me something I probably didn't already know. And there's no,
Well, thank you for
you know,
doing
it's
this.
the standard.
I always appreciate your information and
Get
insight
rest,
on this.
vitamin C,
Today,
go
it's only
outside,
going to
get
go
some
about an
sunshine,
hour.
get vitamin.
Like
Yeah,
Peter said,
okay,
he's
you
not
got it.
feeling that good. I actually have to get back to work here as well.
Yeah,
But
exactly.
I just wanted to give everybody a broad
Well, thank you
perspective
for
on
doing
what's
this.
going
No
on and
worries.
your point of view. I always love your
I always appreciate
point of
your
view on
information and
everything here.
insight on this.
Let's just get
Today,
right into it
we're only
right
going to
away.
go about an
First, I
hour.
want to talk about
Like
actually
Peter said, he's
liquidity,
not
the
feeling that
Feds.
good. I actually have to get
The
back to
Feds
work here as well.
last
But
month
I just
started
wanted to give
losing
everybody a
money. Said they could lose
broad
tens of
perspective on
billions of
what's going
dollars,
on
if
and
not
your point
more,
of
for
view.
the
I
next
always love
couple of years.
your point of view
If
on
they keep
everything
raising
here.
rates,
So
they can expect
let's
it to
just get
be
right into
upwards
it
to
right away. But first thing I want to talk
$180
about
billion.
actually is going to be the Feds. The Feds
What would be the
last month
implications
started
of
losing
this
money.
loss
It said it could lose tens
going
of billions
forward,
of
and how
dollars,
would
if
this
not
affect
more,
the
over the
repo
next
market
couple of years.
and their ability
If
to
they keep
continue to
raising
bail out
rates,
Wall
they can
Street
expect
and the
it to be
banks?
upwards to $180 billion. What would be the implications of this loss going forward, and how would this affect the repo market and their ability to continue to bail out Wall Street and the banks?
Yeah. So that's a good question, and there's no simple answer. So what in the past, like, they started buying bonds, but because they were buying bonds, everyone else started buying bonds and front running them. So they were buying treasuries to, lower interest rates, and of course, and then quantitative easing, they started buying bonds, but because they were buying bonds, everyone else started buying bonds and front running them. So they were buying treasuries to, lower interest rates, and of course, everyone else would buy bonds and like, oh yeah, this is great. So they weren't losing money from 2008 to 2022, because basically the Fed, would basically say, look, we're trying to provide liquidity to the system, and that was basically an enticement to buy bonds and keep rates low. For the market was basically happy to do that, and so as a result, they were making gains on their bond purchases. Now, I don't know exactly what the numbers are for like 2017 to 2019, where they started trying to quantitative tightening, and they reduced the balance sheet from 4 trillion down to 3.7 trillion. That would imply that they were selling bonds, and interest rates did go up slightly, but they didn't raise rates aggressively, and they abruptly cut it short in 2019 and reversed path in 2020. So there wasn't a period when they were doing that minor quantitative tightening where they were losing money. Now, the problem is now that they went crazy in 2020, and basically aggressively bought not just treasuries, but they bought corporate bonds through an ETF program, uh, and so they did. And the amount they were buying was significantly larger, right? So the balance sheet went from 4 trillion to 10 trillion. And so when you're quantitative tightening, though, that's a different story. So when you're quantitative easing, you are buying bonds at a high price, and you're not really caring what you're going to be doing with those bonds later on, because the idea is you're just supporting the curve. The assumption is that over time, losses will be eliminated because, law of averages, they would basically assume that they would be able to keep rates suppressed for a long time. And so buying the bonds at a high price, well, it's financial stability cost, but it's not going to be significant. Now, the problem is that they've gone from a low inflationary environment to a high inflationary environment much quicker than they anticipated. And again, that's a bunch of reasons for that, whether it was politically orchestrated or they're just really bad economists. And it's hard to believe that 800, some of the best civil servants in the U.S. Are capable of being that bad at forecasting, but there you have it. So they didn't anticipate raising rates so quickly. But once they realized inflation was out of control, they had to. And so the problem is now, and all central banks have been in the same problem. It's like they all have these quantitative easing programs. They all said, okay, the first step of reducing liquidity is to stop doing that. Oh, and now we should probably think about buying back some bonds. But it's the opposite thing. You're raising rates, you're causing bond prices to fall, and now you're trying to sell bond prices in a falling market. So you're taking, you bought at the high and you're selling at the low. So for the first time in history, all the central banks are losing money on because for the first time in history they decided, like the Fed has been buying bonds since 2008, but most of the central banks, like Bank of Canada, didn't go along with that in 2008. They only did it in 2020. So that's why you're seeing headlines about lots of these central banks losing money. It's because most of them didn't do quantitative easing, until the Fed, did in 2020, and everyone said, okay, this is serious enough, we should try this. But like the 2008 experiment wasn't, it didn't seem to really matter. It didn't really, every time they thought they were done with quantitative easing, they had to open up like TARP, whatever, QE1, QE2, QE3, QE4. And so, there was a little dubiousness from the community that this was a good thing to do. But, 2020 was so bad, they all did it. And now we're seeing the rocks come to roost. Basically the shit's hitting the fan. In case that, yeah. You're buying when, I should say you're buying when you're trying to prop up the market. Now you're selling to unwind your position at a bad time. So what does this mean for what the Fed is going to do? From an interest rate perspective, it doesn't mean anything. Again, their mandate is inflation, and financial stability is seen as a secondary component. So they will continue to hike regardless of what it does to their profitability. At some point, politicians are probably going to point out, what are you guys doing? But it's secondary to the fact that inflation has to be fought. But in terms of practical effects, what this means is like the Fed is now not going to be like same with the Bank of Canada. The Bank of Canada is not going to be it's secondary to the fact that inflation has to be fought. But in terms of practical effects, what this means is like the Fed is now not going to be like same with the Bank of Canada. The Bank of Canada is not going to be a revenue provider to the federal government. So all those profits that the central banks used to be generating are now losses. What does this mean? This means that the Treasury will have to borrow even more because they can't count on any revenue from the central bank. Will the central bank, like the question is, who's paying for these losses at the central bank? Well, they're going to be unrealized losses, or they're going to be, they are realized actually because they're quantitative tightening. So what is it? It's basically a loss that's borne on the balance sheet. And I don't know how you plug that loss by other than saying, okay, realized loss. What is the share? What is the equity of the central bank? I mean, those are questions I'm not really sure have been really dealt with publicly. I don't know if you have losses over a long sustained period because you basically are selling your quantitative tightening and you're reducing the balance sheet, but you're doing it at a loss. What does that mean for this? Who's paying for this? Ultimately, it's basically the Fed will pay for it by printing money and paper over its losses, but that is inflationary. And yeah, the other side of it is the Treasury won't be getting revenue, so they'll have to borrow more, which is also inflationary. So ultimately, what does this mean? I think it just means that the losses will be papered over by money printing, which will degrade the value of the dollar, which also mean higher interest rates will be necessary, which again will have all the usual knock-on effects to mortgage markets and everything else.
Well, perfect. I mean, you basically answered into my next question. Then I was going to say, if you were the Feds, how would you fix this? Since keep raising rates, you're going to kill your housing market, which kills your pensions, and you're destroying your treasury market. And, the Feds hold 1/3 of their holdings right now as mortgage-backed securities. So you can't destroy your housing market. Demand's insanely low on the treasury, as you were just saying, and insurance companies over in Japan and everywhere else are now selling off. Is there any way for you to see the Feds to fix this other than printing was going to be my next question.
I don't, honestly. I mean, and here's the thing. So the big refrain is like you look at the treasury auctions, there's not a lot of demand. It's like in Japan, the Bank of Japan is like the buyer of almost, the majority of the auctions. And so, the balance sheet of the government is mostly like who's buying the debt in Japan. It's mostly the government, the Bank of Japan. Who's going to be borrowing treasuries? It's going to be the Fed is going to own a majority of the treasuries that the U.S. government issues. And at some point that calls into question the whole validity of the monetary system, right? So I honestly I don't know. Like if you had a fundamental improvement in, for example, all of a sudden you had a bunch of rich immigrants come to the U.S. and they all bought houses, and the demand for mortgage-backed securities went up because these guys are actually paying their mortgages on time. Prepayments go up and defaults go down. mortgage-backed securities are a good investment. Okay, then the Fed can sell off those MBSs at a gain, and that'd be great. But like that's a fairy tale syndrome, right? It's like people coming to the U.S. do not have capital. They're capital scarce, and they want to be in the U.S. to earn capital. So, yeah, I mean, the miracle of a high, like, the other thing would be like if everyone was suddenly more productive and the GDP of every country, especially the U.S., jumped up dramatically, then yeah, the Fed will probably find more buyers for their paper. But in the time, if they're not, then they have to do it. They have to basically print money to paper over the losses. And so inflation is a natural outcome, which means the Fed either ignores the inflation and we're all suffer longer term, or the Fed thinks that they need to hike to do something about inflation, which means we're going to see a cratering of the market and the housing market, everything. So right now the Fed is talking like they're going to basically keep hiking. And that's I don't know if that's one of your later questions that might come up, but like the assumption was they're going by 75 basis points next week and 50 in December. And in fact, prior to last week, there was some talk that the dot plot for the last Fed meeting is out of date, and they might actually go by 75 in December. So they might even go 150 more this year and then more next year. But then there was a comment from Fed official Daly who basically said, yeah, we're thinking about staggering our hikes, in terms of amounts. So maybe we go to 50. And then the Wall Street Journal, basically the mouthpiece for the Fed, who works at the Wall Street Journal, basically put out an article saying the same thing. So there is some sense that maybe they're going to dial back. And we saw that this week with the Bank of Canada. The Bank of Canada was expected to hike by 75 basis points this week. In fact, there was more than that priced into the curve, and they only went by 50. And they had given no warning to the street at all about this. So, like, it wasn't, they're getting questions from the banks. Like the banks are going, you guys are supposed to be transparent. And the bank, we said, well, we still hiked by 50. And that is, 50 basis points is nothing to shrug your shoulders at. But like, there was no communication at all that they might be not going by 75. So the Fed, now there's a question, does the Fed go by 50 next week? And again, are they bowing to pressure? Are they looking at the housing market like the Bank of Canada did? The Bank of Canada did this because they were worried about the housing market. So the question is, does the Fed have those same concerns or not? So next week will be pretty interesting to see what they actually say. My personal view is that they probably still go by 75 because, again, the Fed's a little more active in being transparent. If they were going to change expectations, they should do a little more active about it. And but yeah, I mean, it's really a question of like, I liken it to this: like when you rate hike or rate cut, you're not expecting an immediate impact. There's always a lag, and we've always said in central banking that it's 12 to 18 months. But that may or may not have changed. Like that's that's a theory that's been dreamt up when I was 20 years ago when I was in Ottawa. So is that still hold? Is it a shorter time frame or is it the same time frame? But anyway, it's like digging a hole or adding fuel accelerant down the road. You don't know exactly what you're facing down the road. You only know that something's going to happen down the road. So if you're hiking rates, it's going to have an impact on the economy down the road. Just how big an impact? And the thing here is the Fed has been hiking faster than any previous rate hike cycle, and the rate hikes, like typically it's a 25, 25, 25, 50, 25. They've gone like 25, 50, 75, 75, 75. It's like, this is unprecedented. So we don't know how big the hole is that the U.S. economy is going to be running into. So if you were a prudent central banker, you might, like the Bank of Canada, actually take your foot off the accelerator. But I don't know if Powell's that prudent, and he's more worried about his reputation. And again, inflation is a political mouthpiece. The Republicans say, look, the Fed under Biden has been shitty, not doing their job correctly. So even though the Fed's supposed to be independent, they'll try to, I'm surprised there hasn't been more linkages as to economic performance and the Fed. So I do wonder if the Fed feels pressured just to go by 75, just to basically look like they're fighting inflation. So that is my sort of biggest interest for next week.
No, yeah, and I agree. They'll probably go with the 75 also with midterms coming up as well, I believe. But the next question I got for you, we're going to actually kind of move a little bit towards them as well, but it's going to be about the pension funds. So we know that there's a lot of pressure currently on the pension funds with the treasury bonds, the rate increase, you have increasing collateral requirements. Now there's a lot of liquidation going on in blue chip stocks. What do you think is going to be the effects on the pension funds with this liquidation going on? And you also are seeing Bank of America warning that there's going to be United States Treasury market is going to be at scale of a large sell-off.
Yeah. Yeah. So, I mean, I know you're going to have a UK question, so I'll not talk about them yet. But the same problem the UK faces, the US is going to face. So pension funds in the US have, when you basically have a central bank that's suppressing rates, as the Fed has done for the last 12 years, 14 years actually. So when you got a situation like that, your returns on your assets, because you're basically what's called liability-driven returns. You're looking at your obligations from your pension funds, and you got to deliver a certain amount of money every year. So you structure your investments so that your bond portfolio will provide that kind of income. You want to minimize the surprise from your asset side. So, and again, they have actuaries that try and calculate the liability side. But reality is, your pension fund should be more worried about your liability surprises than your asset surprises. So you try and be safe. You try and buy long dated bonds with coupon payments, and you can calculate your cash flow. But what's happened is, as interest rates have been suppressed for the last 14 years, your bond yields don't like to provide a certain guaranteed income. Like, again, a lot of people have gone to defined contribution plans, but defined benefit programs basically put you out as like, this is how much so and so gets per year of service, whatever. So you have to have a certain amount of return for these pension funds, and you can't have shortfalls. So they sit here and they look, well, I'm not making enough income from this bond portfolio. We got to do something crazy. Okay, so, well, so and so is offering this little ETF fund that will do this, blah blah blah. And it's like, well, how do they generate the guaranteed return of 10%? Well, they do this, this, and this. Oh, that sounds great. I don't want to know. Just okay, I'll buy this stuff. And a lot of pension funds have basically wound up buying some sort of hybrid equity, fixed income product that has all kinds of like derivative exposure to it. They could say, oh, it's a high credit or whatever. Maybe it is, maybe it isn't. So you don't know. You get Frankenstein type products that the pension funds have been buying. And that's fine as long as interest rates are stable. But then you have a political event, or you have an unprecedented rate hike cycle where the Fed is hiking faster than expected. And I just said that we have seen that. All of a sudden, the returns on these Frankenstein products, well, they're risky. Like, you got a liquidity issue. Okay, well, I don't have that much cash available. Like, we have long-term bonds. Well, if you want to not avoid a margin call, you're going to have to sell some of those bonds. So they all wind up selling the same because they're all structured the same. They all have long-term bonds so you got to sell your 10-year treasuries or 30-year treasuries. Gee, what happens? They're all selling at the same time the Fed's quantitative tightening. So yeah, there's no buyers for these things because everyone's trying to sell them at the same time, and as a result, yields go up. And I do believe that when we saw 10-year treasury race to 435 week and a half ago, that was probably some margin calls going off, or margin call avoidance. So it's like, okay, we're going to sell some bonds. And look at 30-year mortgage rates, and 30-year bond is at all 40-year highs. So it's, again, that these pension funds are probably reeling. They're probably getting margin called, and yeah, like having their equity. If you have equity, their equity portfolio is getting nailed as well. So it's a real concern for, like, if it's a pensioner in the U.S. It's like, what is going on? Like, do I want to know? Because it's like I've got it. Like, if you're defined benefit, then the expectation is your employer is basically going to have a well-funded pension plan. But if these pension plans are bleeding funds and they're making, having to sell their assets, then it's not guaranteed that they'll be able to service their pension obligations. So that's the mystery as to what's going to happen. I mean, that was the concern with the UK. Of course, it was going to be like an instantaneous blow up. So the question is the U.S. heading that way? And there's no reason to suspect that U.S. pension funds were any better managed than UK pension funds because they had the same problem. It's just a question of how big a stress they have, and we haven't, like, again, I don't know if 4% 10-year treasuries matters, or is it like 5%. At some point this becomes a huge issue, and I think we've already sort of toyed with that. I mean, the market just did not like, you saw what happened in everything when treasury went to 435. So I do worry about pension funds, and I do worry about pension fund holders in the U.S. Yeah, I mean, you manage pension funds that you don't have any control over because it's basically your employer managing, selecting a manager and manage the funds for you. It's like that can be like it would be scary because you have no real control over what they're doing, and they've been probably doing stuff to try and jack up returns that's going to cost them now. So.
I mean that's perfect, and I agree with everything you said. I've been saying that for a while. As everybody watch over in UK, and that's pretty much what's going to start happening here because you're getting no demand for these treasury bonds. And my next question was going to be because the Feds are now starting to lose money. And I see the UK situation, as you brought all that up, it was perfect timing because as the UK situation, Bank of England had to start repurchasing debt. Well, are the Feds going to be able to do that here? And if not, I was going to say, what do you think the risk of these pension funds actually getting margined is? And I think it's getting greater by the day.
Yeah, I mean, and that's the ridiculous thing. So, as I said, the Fed lost a lot of credibility in 2017-19 when they U-turned on okay, we're going to reduce our balance sheet and we're going to hike rates at the same time. And I mean, I was sitting here going, how are they going to do that? Because it's like just a double whammy. The market was addicted to low rates, so the Fed's hiking rates. Oh yeah, and they're also selling treasuries to try and reduce their balance sheet. And of course, they had to stop doing that. So they lost a lot of credibility because their normalization of the balance sheet stopped after less than you go from 4 trillion to 3.7. Well, you're trying to go to 1 trillion, so you lost a lot of credibility. So here they are, making these grand statements about we're going to increase our quantitative tightening to this and this and this, but again, they're trying to sell treasuries in a market where no one wants to buy it. And the other side is, if they were to basically come in and okay, we got to reverse course and buy treasuries to stabilize the pension fund. Well, then they can't be quantitative tightening if they're, basically, they're stopping that and they're going to lose more credibility by doing that. So I've seen some people suggest that the Treasury, some of the comments by Yellen are trying to create a pseudo second central bank. So you have the Fed selling treasuries and then you have some, financial stability group buying treasuries. So that may be one solution. It's kind of BS because you're basically, you're creating another entity just to do the opposite of what the other entity is doing, and you basically have a wash. So you're not really quantitative tightening anymore. You're basically creating, you've got one long-term buyer, and then you got the Fed. Okay, so we're basically selling short-term treasuries, so it's not the same. They'll basically say some kind of yield curve control exercise where, we're quantitative tightening. We're not selling our long-dated treasuries. We're selling our short-dated treasuries, and they can get away with that. But then that has impacts on the yield curve. So I don't know if that's the solution, but that'd be one way to basically support the pension funds by creating some sort of special entity that exists only to do that. And then they'd be buying long-term treasuries, and meanwhile the Fed would be selling other treasuries or selling MBSs or something. But again, how do you fund that entity? That entity will have to get cash from somewhere to buy these bonds, so they'd have to print money, which would be inflationary. So it smacks of there's just no easy way out here. It's a credibility problem no matter what happens. But I think they're going to try some kind of financial skullduggery so that the Fed doesn't have to stop their quantitative tightening policy. It may just say, just simply like an Operation Twist. We'll be selling short-dated treasuries and buying long-dated treasuries. Then they can try and justify that. But everyone knows it basically is they're just trying to support the pension funds. They have to. And if they don't do that, then, that'll be financial Armageddon. Because, as you said, the biggest concern is the demographics in the U.S. are that a large amount of the population is soon to retire in the next 10, 20 years. And if their entire retirement funds have been blown up by the banks, they're not going to be happy. And you talk about civil unrest. It's one thing to have, racial disharmony and, the 1% gaining lots of income. But if the majority of the population loses their retirement savings, it's game on. And it's there'll be regime change for sure in Washington after that. So I think they have to rescue the pension funds. Otherwise, they have a huge demographic problem to deal with.
Oh, no, I agree. And with all the billions and billions flowing through that, I can't imagine what that would do to the financial system. The next thing I was wondering about is going to be the reverse repos and the treasury demand. Since demand's getting lower and lower, they're going to have to keep doing interest higher and higher. Do you think we're going to start seeing a lower and lower amount in the repos, which is what they use as collateral to help bail out these banks?
Yeah, so the point about the repo was created to sop up all the liquidity that the Fed created. Now, if the Fed is going to be continuing to hike and continue to reduce the money supply and continue to quantitative tightening, which reduce the money supply, then the point of that excess liquidity, it's like, I look at it this way. I've been telling people, look, the Fed is trying to say, yeah, we're credible on inflation. We're going to hike rates. That as I said, that digs a huge hole. To offset that, I think they have been discreetly intervening in the equity index futures. You see these magic, huge tickets on a Friday afternoon out of nowhere. You see these magical openings on Monday morning where, there was all this bad news on the weekend, and Credit Suisse, 2 weeks ago was going to implode, and all of a sudden there's this huge equity rally. As I think the Fed has been active intervening on the Chicago market and the index futures to support, so you have, on the one hand, they're basically crushing the market, and on the other hand, they're supporting the market, which is why we have all these ups and downs. And I don't have any proof to that, but that seems to be what I think is happening. So the reverse repo account is another form of a liquidity buffer. And as they continue to damage the economy on one end, they'll have to start, they've been draining liquidity. That reverse repo is a liquidity pool that hasn't really been tapped. We saw it go to 2.4 trillion, and then on September 30th, and then it went to 2.2 on October 2nd or something, because it was month end, window dressing or whatever. But that 200 billion that drained out of the reverse repo, that went probably into equities, and that's why we saw that big jump up in early October, which again was I think coincided with the Credit Suisse issue. But I think that's what's going to have to happen, is they're going to have to entice people to get out of the reverse repo by either reducing the limits on what people can do in it. Like they jacked up the limits for participants two times, I think, and they also widened the number of participants that can participate. It's hard to walk that back. They can't say, oh, so and so broker, you were allowed to do this, but now you can't participate anymore. So they can't. It's hard to walk that back, but they can reduce the limits, or they could reduce the interest rate that they pay, because they pay 5 basis points over Fed funds for that. If they reduced it back to Fed funds, or they reduced it to -5, then you'd have people like, oh, okay, it's time to leave. And I think that's what they'll have to do, is incentivize people to leave the reverse repo, and all that cash that's sitting there will go in and prop up liquidity. But again, it's a safety cushion, but they're still going to have to hike. So all the reverse repo is, by draining it, that basically helps support the market, just like intervening in the index futures would. But on the flip side, as you said, a lot of people are relying on the reverse repo for the collateral impact, because treasuries are expensive. Even if, relatively speaking, they're cheaper now, they're still the most expensive form of collateral. So if you can park your cash at the Fed, get 5 basis points over Fed funds, and you're getting treasury collateral with no haircut, then you can use that collateral to go short AMC. So that's what Citadel's probably been up to. That's what, these Lions guys are sitting here like, yeah, I've got cash, I'm going to park it at the Fed, and then I've got collateral to borrow against, and so I can go fund these shorts. So that's what I think is happening. And so the flip side of it is, yeah, as the reverse repo drops, I do expect the shorts to get under pressure as their source of good collateral disappears. So that's an interesting development. I'm really waiting to see the reverse repo drop below 2 trillion, and see how fast it drops, and then I know, okay, the game's closer to ending. Because it is one thing keeping these plays alive at the moment.
No, you led right into my next question beautifully. It's just crazy. And at this point, I was saying my next question was going to be the Fed's, basically all their weapons to help Wall Street is drying up. And as they're starting to see, the pressure is going to start mounting on these pension funds. And I believe soon the Feds are going to have to make a choice, either help Wall Street or, finally have to go with retail. And I mean, you basically, I was going to say, do you agree with that? But you pretty much went right into that.
Yeah, my view again is like, you can abuse Main Street like they did in 2008. It's like, yeah, it'll defer. It'll be an inflationary tax, but it won't be noticed because it'll take a long time, and there's deflationary forces. So yeah, we can bail out Wall Street without too much impact, and they just kick the can. So the problem is that they kick the can, and there never has been any. Like I said, they tried to reduce the balance sheet. It didn't work, and a new crisis came up, and as a result, now you have an inflationary problem, which does put pressure on yields, which they have to deal with, which means the pension funds get hammered. So it's this minimal cost to Main Street that 2008. Yeah, we can bail out all the banks, and we'll just hide the cost. Well, they can't really hide the cost as well anymore, and now it becomes a problem. If you have so many people
that are going to lose a lot of their life retirement funds. And I mean, the flip side is a lot of baby boomers are like, as they pass away, the inheritance will go to presumably the same people that are about to retire. Like, I don't know, like, does Gen X get a lot of baby boom money? Do the millennials get that money? I don't know. So that's an offset, but it's still the amount of money that's being killed right now is significant enough that it'll be dangerous for politicians not to do something to address the fact that Main Street is getting killed on their pensions, and they can't let it continue. So yeah, Wall Street doesn't have the same like free pass. I don't think I honestly they probably will bailed out again, but the Fed and the government has to come up with a more creative way of hiding it, because again, hiding it through long-term inflation isn't going to work when inflation's out of control already. So.
No, I agree. And I mean, this is one of the things I was talking about a long time ago. We need to start seeing liquidity and collateral start drying up for these people. And a lot of people, they sit there and watch the line daily, and the line is how they determine if we're winning or not. And I tell people to look at the back end. And one of the things I wanted people to, look into the back end to kind of get your opinion on is, you have hedge funds that are actually starting to change their strategy. They're not going short as hard in that nature. And what they're actually starting to do is they're switching over to buying junk bonds at super discounts and holding those premiums as collateral for the banks now. They have the most junk debt since 2020. What are your thoughts on that?
Yeah, well, so we already saw this. Like, they were the idiots that were saying, "Oh, we're going to buy the Russian debt," right? So yeah, junk bonds is probably a safer choice than buying Russian debt. But again, you're on the assumption here that, okay, this is really cheap. These companies will be around. The Fed will do a pivot. They'll stop hiking. So we're buying these bonds at the cheapest price, and there's a limit. The junk bonds are, again, it's like there's a risk they go default and go bankrupt, but they're taking a bet that'll be limited. Like, whenever you look at, you calculate the price of a junk bond, you got to calculate the default risk, and then that entails the credit rating and all that other stuff, and where CDSs are trading for the respective companies. So they're making a bet that basically the risk of default is overstated and that these bonds are cheap. And so the risk, they think, is that the Fed will be forced to stop hiking soon, and then therefore the value of these bonds will go up. So therefore, yeah, like as you said, they're realizing gains, expected gains, and using that as collateral. But yeah, like the Fed could surprise them. I'd say, based on what the Bank of Canada did this week, that maybe they're right, and it's a good bet, because the Fed will cry uncle, and it. But if they don't, if the Fed keeps hiking, then those junk bonds are going to get massacred. So, and they think these hedge funds. I was in an earlier space call with a crazy lady this morning. I was saying, look, a lot of the guys that work at hedge funds aren't necessarily the brightest people in the world. They're better connected than you or I. They went to the right schools. Their dad went to the right schools. They know the right guy. The guy that they was at Goldman like a few years ago as a hedge fund, and he's looking for guys, and he prefers to hire guys from Goldman because he knows the culture, blah, 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 blah. And as a result, you get some average to mediocre guys running some of these funds. And the classic example is Tiger Global. The guy is down like 60% this year. And the reason he has his job mainly is because he worked for Julian Robertson at Tiger Fund, Maine, and Julian valued loyalty more than anything else. So he basically gave out seed funds to all his like employees after he retired. And some of these guys, not necessarily the best guy traders in the world. So yeah, if some of them are stocking him on jet debt, some of the other guys, the same guys, were trying to buy Russian debt at a discount, thinking they could still trade the stuff. So maybe they, and that's why they had to create those special allowances for, JP Morgan's allowing Russian debt trading for limited time only, just so you can get out of your position because you're stupid enough to try and get in it. So I think that's the risk, is that they're wrong about the Fed, and I just because they're buying junk bonds doesn't mean they're right. I mean, I said the Fed keeps hiking, those guys are going to get nuked.
No, I agree. I mean, and then that leads into the next question also, which is, new hedge fund launches are the lowest since 2008. You're seeing them take losses across the board. What is that telling you?
Yeah, and that's it. This is a market where there really isn't anywhere to hide. It's a question of, like, how do you lose less than the other guy? And in that environment, like, who's going to fund a new hedge fund? You got to have either an awesome track record or B, you can't find someone that's got too much money and doesn't know what to do with right now. Everyone that's has funds is basically sitting here going, I'm going to be very careful about what's going on because no one seems to know what's going on. So I'm not going to lend my money to any Tom, Joe, and Harry that comes by. So just because you worked at Deutsche Bank for 10 years in equity derivatives doesn't mean that I believe that you have any more insight than this guy that worked for Credit Suisse and is lucky begging for a job. So that's the thing. A lot of these hedge fund guys are ex-bank guys, and a lot of times they get a decent bonus at a bank, but then they say, like, I can make much more working for myself. And then they go say, look, hey, rich guy, old money guy. I worked for, Goldman for 5 years doing this, and I work for this guy, and here's my performance, and, I can make you this much. And then they give him, oh, here's 100 million. And then, go talk to my friend. He's got a few 100 million. And so you get a few 100 million, you got your 500 million fund. And then but that's, that way of doing things, I think people are not going to be handing out 100 million checks easily now. So I think in this market where, again, when you have someone like Tiger Global losing 60%, it's like I was saying on the other call, it's like, yeah, you long AMC and you've been losing money all year. Well, are you losing as much as this Tiger Global guy did? Is your portfolio down 60%? And this guy's supposed to be diversified and have inside information. Yeah, so I don't think these hedge funds are going to find funding very easy for the time being. And that'll only change when the Fed does pivot and that reverse repo funding liquidity is out there, and we go back into it. Like, I guess I'm of the view the Fed cannot get inflation under control. It may not be hyperinflation, but it will be an inflationary world. And if you look at Venezuela, the equity market in Venezuela is super pumped. So the only way these guys will get money is if we start to revert to where, like, there's a lot of liquidity back, and, like, there's going to be more margin requirements, and hopefully the regulators have a better handle on things. But reality is the equity market will get overflated again, and that's when these guys will probably get their funding, is when, oh yeah, look, like, I'm beating the index. Well, only because you're in a stock that is doing 20% up when the index is up 10%. So that's where I think they're not dead, but for the time being, new hedge funds are not going to be finding it very easy to get started.
No, and I agree with you right there. And, that's one of the things why I say to a lot of people, the meme stocks versus blue chips right now. And, I'm not giving financial advice, but it's just, if retail's sitting inside of these things and they're holding, yeah, like you said, we lost value. Of course, they're going to keep shorting, doing everything they can. They can't, they're going to keep liquidating other things to hold this play as long as they can, because they could get just dismantled by it. But in the end of the day, they're going to keep liquidating blue stocks. So that's, blue chips, which is what institutions own compared to retail majority owns, AMC. They own, the GameStop, and most of them aren't going to go anywhere, which is why I was saying the only way I believe the Feds can truly fix inflation in these things and what's going on is a MOAS, because you've taken so much out. You've taken, everybody, none of us have any money. The credit card debt is at an all-time high of $930 billion. Nobody has anything. And if we're not going to your guys' businesses and your companies, look at profits across the board, they're dropping. You just saw everybody's earnings. Everyone's losing money. Why? Because we don't have anything to go spend on it. And in the end of the day, these guys' companies are what gave them the ability to be this rich. That's what gave them the ability to have this credit. Well, if the guys that are supposed to be the richest in the world now can't get credit and they're losing money, the only way to do it is to start selling off these assets and redistribute it to the economy and give it back to your middle class, because in the end of the day, they're going to give it back to the 1% going to their businesses anyway. So who cares? Or, like you said, they're going to have to print more. But if they print more, I mean, oh my God, like, your inflation's ridiculous. And like you said, you'll never be able to get ahead of it, and you'll just live in that kind of an era forever.
Yeah, and that'll lead into one of your other questions, I think. But so yeah, how do you get this? You do need a reset. Yeah. And you go to a digital currency, and that basically that's can kicking things. You'll have this digital currency. It's like, one for the dollar, but that digital currency will lose value fairly quickly because it's got to hide all this inflation that's been created.
Yeah, I agree. And, now that you're leading to digital currency, perfect. Let's go right into the next thing. What are your thoughts on the new prime minister over there working at Goldman and how he is so for a CBDC and a carbon credit score?
Yeah. So, I mean, it's well known that he's a Klaus Schwab, I would say junkie, but like he's he's WEF agenda, right? As for the Goldman thing, like let's be clear. This guy was finance minister under Boris, so but his resume is kind of curious because he came from an upper middle class background. His parents emigrated from Africa. They ran a pharmacy or something, so he had money. He went to Eton or something, $60,000 a year tuition. So he got a good private school education in England, which is usual mark of upper class. But his time, like that's how he got a job at Goldman. But he joined Goldman in 2001, which is 9/11. So if you basically, my memory is hazy about what was going on in the investment banking world, but I do understand that they were retrenching. Goldman was in one of the rare periods where they were firing people. So his initiation at Goldman wasn't all that spectacular, and he wasn't really, like, from what I've read in various synopses of his life, he wasn't very happy at Goldman. So he left after 3 years, which hardly anyone does, right? And he went to Stanford to do his MBA. So it's like, this investment banking thing's not working out for me. I'm not really into it. They're not paying me enough, and all my friends are getting canned. So he went to Stanford. Then he met his wife. And his wife is the daughter of like an internet, like the Bill Gates of India or whatever. So his wife is going to inherit like several $100 million. So in US dollars, he's about a billionaire, but it's all his wife's money, right? It's like, so he comes from a wealthy family, but like upper middle class, whereas his wife is super rich. So when people talk about his wealth, he didn't make it at Goldman. He made crap. He didn't do anything at Goldman. It was all his wife's money. But the fact is, now he's in office, and yeah, he is, again, probably from his wife's connections. He's affiliated, and again, when he was working for Boris as finance minister, he has connections to the WEF, and their agenda is several problematic things. And like the conspiracy theorists would find everything going wrong in the world is related to Klaus. And I'm not saying no. I mean, there's a lot of weird things that are happening that I wonder about. So anyway, the fact is that he is talking about a digital currency. And again, I look at the inflationary picture globally, and I don't see can kicking be an option when we're back to 1980s inflation, and debt levels are so much higher than they were in 1980. So how do you get out of this? You just, I said, I don't see any ability to, unless there's some super productivity that happens and we're all wealthier, then I think the inflation has to be hidden or just basically gotten rid of through a reset. And so the digital currency is that way of doing it, because you're resetting things. You're not getting rid of the problem. You're going to hide it, and you're going to redistribute the problem. And the thing about digital currency is the dangers of it is you can manipulate it in so many ways. Like, okay, well, so and so is voted for this. If you vote for this thing, you get more. You can make it the currency has a time limit, or you can this guy has to spend his in a week, but this guy can take a month because he voted for this proposition. So you can start adding political, like I say, it'll be totally unpolitical and anonymous. Yeah, right. It's all digital. It can be tracked. It can be hidden. You can have hidden backdoor. Like, I'm not an IT expert, but I am dubious about something that's completely digital, because there's all kinds of ways. What's the code of the? We can't tell you what the code of the digital currency is. That's proper. So there'll be all kinds of weird things that are going on with digital, and they can manipulate it to suit their agenda. So that is the risk. Is what is Klaus's agenda? And I've heard some troubling things attributed to Klaus. It's like, well, some of you will die, but that's for the benefit of mankind. It's like, yeah, I didn't volunteer to be Spock. Thank you.
Like what?
Spock is like the good of the many outweighs the good of the few, right? So Klaus is basically going to if he's saying some of you have to die so that the world will be a better place. It's like, well, who are you to decide that, right? So I think that's my issue with Klaus is it's like, we're going to improve society, but a lot of you are going to suffer for it. And that's like a very Machiavellian political type of view, but I think a digital currency can be manipulated to advance that view, and that's my concern about it. But I don't see any solution to getting around the inflation problem. So.
Yeah, no, and I mean there's two parts into this next thing here. So yeah, I mean I agree with you on all that, And the first thing I'm going to say is going to be about crypto and how they're talking about that, lean into what you were saying. Now it's a matter of national security, and how, we need to get these controlled, and it's vital for, the central banks to keep their role in the economy and all this stuff. And I think that is more, the reason that they don't like crypto is exactly what you're hitting on, is when they make their digital currency, all that does is it extremely limits to how much debt or how much they can hide. And, and that's going to hurt inflation. And like you said, it all leads into them saying, well, it's always for the betterment of the good. And then, I don't know if you saw that video I posted on, a couple of days ago, and the guy was talking about CBDCs, and he's talking about everything you were saying, and he's talking about like a carbon credit score and policies. If we guys don't like this, we can control what they spend, and that led into what you were talking about the other week, where let's say they give out stimuluses, or let's say you have money and they need to boost some part of the economy, or the rich people got control, because we know that they can do it. Obviously they got that power. They can force us to buy into that type of thing. And that can, that gets rid of complete freedom in the United States. I mean, literally, it gets rid of everything we stand for. That's why I just can't stand CBDCs. But what are your thoughts on crypto and why they think it's such a national matter of security? Is it because of what we just touched, or?
Yeah. Like I said, I've been like on LinkedIn, like for years, even before I got noted for AMC, I was talking about crypto. I knew from coming from a central bank, there's no way that any central bank would allow a crypto to become the dominant, okay, if in a little niche where less than 5% of the people are using it, then okay, maybe. But if you're talking about, crypto is going to be the way of the future, and BTC is going to surpass all currencies, you're going to run into problems, and you're going to run into the authorities basically saying, no, 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 no. And my only surprise was that it took the Fed and the federal government so long to start talking about regulating it. It's like I think BTC has had a ride about 5 years longer than I thought it would. Now that being said, I do think that regulations will eventually stamp out most of these coins. But like you can see that, like, you could argue, and again, I'm not even going to say the conspiracy theorists are wrong, that the whole attack on Luna, because it was technically a stable coin, US dollar stable coin, the attack was engineered by BlackRock and Citadel at the behest of the Treasury to basically reduce competition. So you want to destabilize the idea of stable coins, you go after one that's easily, like, whatever Duquan or Doquan, whatever his name is, he boasted up saying, you guys can't touch me, I'm too big. Yeah, there's a vulnerability, but no one will be able to exploit it. But if you had enough people, like enough capital, you could exploit it. And if BlackRock and Citadel did it, then that's someone who did it. So Luna got nerfed, and of course Tether's been a problem, and I think Tether is a sham anyway. So it could be a question of just waiting to stamp out these stable coins, and get the regulation in place, decide if the CFTC or the SEC is going to regulate it, and then basically most of these coins are going to go bye-bye, but I think Bitcoin's too big. So there'll be some cryptocurrencies, and maybe Ethereum, I don't know, like there'll be like I said, it's a wild west now, and it'll be like shoot out the OK Corral, where a lot of these currencies, cryptos, will get nuked. And then the authorities will come in and establish orders saying, you guys are unregulated, you're a danger to society, we're going to take over, and we'll let some of you live, but you're going to abide by our rules. You're going to be regulated, and Coinbase, you're going to be following all our rules, and so it'll be a less innovative place. And that's sad, because the whole idea of people that came up with cryptos was like, this is an innovation to make things better, but it'll be co-opted by the authorities, and the authorities will decide what's better. So that's my view, is cryptos have a place. I think it's going to be an endangered species, though. Again, trading something like Luna, some people still trade it back and forth. It's like, it moves, it trades. Okay, I'll make money off it. But the time frame for that, these things existing, might be coming to an end. I just, it's surprising to me how slow the authorities are, given the threat to the fiat currency system. If you do put out a digital dollar, then there's no place for both. There's no place for both being dominant exchanges. So you can have BTC for 10% of transactions, but even then they'll be regulated. And I don't think that's the whole point. BTC was supposed to be unregulated. So it seems like a corruption of the crypto world. Either it gets totally stamped out, or what's allowed to stay around will be not what was envisioned. So. That's my
No,
story.
I agree with you. And like you said, just like always, the corporate empires get together and just stamp out the competition.
Yeah.
It's so ridiculous, man. It's crazy. So we got to talk about it before I get into the next thing. I got to talk about, everybody wants me to ask you about, what are your thoughts on Credit Suisse laying off the 9,000 employees, restructuring? If they go under, how would that have implications on the Fed, seeing as how we saw that they gave them around 16 billion in loans?
Yeah, well, let's be clear. They loaned the money to the Swiss National Bank, which then lent it to Credit Suisse. So ultimately, if Credit Suisse goes down, the Fed is not going to be bailing them out. It'll be the Swiss National Bank that bails them out. So
Okay.
that's one point to be clear on. And it's all U.S. dollar swaps. So who knows what the term of that is? Basically, Credit Suisse, U.S. dollar was really strong. It still is quite strong. The problem was that if you start needing several billion in liquidity, that's going to make it even more expensive. So as opposed to buying the U.S. outright in the market, they decided to just ask the Swiss National Bank to use the Fed facility with central banks for U.S. dollar swaps. So if you look at it, I think there's hardly any central banks that are actually using that facility. So the Swiss National Bank is at 11 billion or something, and I can't remember, the Bank of England's at 400 million, and no one else has used it. It's that's pretty shocking how much they've taken. But it just shows you how Credit Suisse is saying, oh, we don't have a liquidity problem. Yes, you did. And the annual results or quarterly results that came out yesterday, 2 days ago, basically indicated they were on the verge of a liquidity issue 2 or 3 weeks ago. So the share price obviously dropped 20% because people realized they were just bluffing. They were in trouble, and they still remain in trouble. And use of that Fed facility and the Swiss National Bank giving them that funding for liquidity purposes to help their U.S. dollar operations, it's indicative of an entity that's in problem. So this is why this restructuring, they're concentrating on selling off part of their U.S. arm, because honestly, they don't have the capital to support all their businesses, and they've been losing significant money for the last few years. And I don't know how Greenswell was 500 million or something, and Archegos was 5 billion, and a few other hits. They're taking fines, $200 million fine for I can't remember what it was, not stating something, or tax avoidance issues. They're being fined right, left, and center as addition of these losses. So they've been bleeding capital, and they have not been a well-run bank. And I think this is the third CEO. Two CEOs ago. The CEO had to resign because he was hiring private detectives to follow his own staff. It's just one mind-boggling stupid thing after another. So the company has not been run well. I don't like it. And then of course you can point to putting out an AMC hit piece yesterday. Why would they do that? Maybe it was pre-planned and they had no relation to the quarterly report. It just, the optics look stupid. And of course, again, I've been questioning. It's they put out a report on Cinemark 2 weeks ago, and they said, our target's $9, and they basically said, it's the pickup from the COVID lockdown is over. Theater revenues are going to start falling again. Blah 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 blah. But they still give Cinemark a $9 share price. But AMC 95 cents. It's that's so comically bad. It's it looks like a Motley Fool headline. So I tweeted yesterday. It's you might as well hire someone from Motley Fool, because this is the kind of stupid target that they would come up with. There's no rationale for Cinemark to have a $9 valuation and AMC to be at 95 cents. Even if AMC diluted their shares, it's not enough to justify a 9 times valuation, right? So
not only that, they still got Ape at their disposal. They just restructured debt and pushed it out. I mean, all their immediate things are taken care of. And if they do sell Ape, if Ape does get to a better price and they sell it, now all their debt that they just pushed out, they're ahead of schedule on a payment. So it's there's literally nothing to justify that. On top of that, with Paramount, and now they're moving into Saudi Arabia with IMAX, as you saw, that's crazy.
Yeah, and that's it. With all these hit pieces, they always annoy me because it's never a full. They always slant it, of course, but it's comically bad as they don't even talk about the short positions or any of the failed to delivers or anything like that. It's always the fundamental story, and as we know, AMC is not a fundamental play. If it was, it would never gone to 72. So this is the thing that they totally disregard that part of it. And maybe they feel they can't talk about that because we're a respectable organization. But even Multifold never talks about it either. So, but it is comically bad. And again, we know if I haven't got their DD in front of me, but last time I mentioned this, people came up with DD saying, yeah, Credit Suisse has been an active shorter of AMC. They're the second most active or the fifth most active. So they have been very active in shorting AMC. So you got to, again, is this a self-serving piece of information? Like, are they trying to increase their value of their short position while they're trying to raise capital? It's plausible. So I laughed at the AMC report. And as for the entity itself, there's a zero hedge story this morning, basically saying like even a day later the restructuring plans look to have some holes in them. So, one of the big holes they point to is like they're going to separate their U.S. units and they're going to try and they're going to try and box them so that some of the liabilities aren't payable back to Credit Suisse. But the reality is, ultimately, Credit Suisse has to be the backstopper for these entities. So they're going to basically cut them up, and some of the the M&A services will not have direct access to a trading floor like they used to. So if you're going to try and promote someone to do an acquisition, well, usually you rely on the trading desk to if you're doing a bought deal or whatever, you need the trading desk to be with you as opposed to a separate entity. Because once you get to a separate entity, that entity will not be working for your benefit; they're working for their own benefit. So the whole idea of splitting up the U.S. operations is haphazard. And I'm like, again, I'm trying to separate my annoyance with the AMC report with the overall restructuring plan. But I do think that the restructuring plan is going to be problematic for them, and I do think they're not going to be able to raise capital as easy as they think they are. So, I'm not going to be silly here and say, Credit Suisse is, predicted price is 90 cents, but I think they will be continuing under pressure, and I think they are the sick bank of Europe, and I do think the ultimate outcome of this is a merger between UBS and Credit Suisse. Don't know the time frame, but that would seem the most logical outcome of all this.
And it's funny because those are two of the three banks that I've been saying for a while to watch them, Deutsche and UBS, and those will be the three that could be the big swan event. So if those two merge, it'd just be poetic for me. But I just got three more questions for you, quick. I know you want to get going here pretty soon. Do you have time to answer those, or do you want to get going?
Yeah, I should be okay. It's just my voice holds out, but yeah.
Okay, so first thing I'm going to talk about is a market crash here, quick. You got a market crash. Do you believe a market crash, there's a chance of it being bigger than 2008 with the Feds losing their ability to prop it up and everybody being more overleveraged than ever? Credit default swaps are higher than they've ever been across the board on all banks. Or do you think they'll be able to get a digital dollar in or some kind of bailout before they would allow that?
It certainly feels at the time being that they have been very... you look at March when the VIX kept going to 35 and getting immediately cut back down to 30. So they've been active all year in trying to, avoid contagion fears. Again, the magical equity move higher the weekend that Credit Suisse was initially thought to be in trouble. So I think they are active in trying to support bottoms here. And so you've seen these weird little artificial rallies that last for a week or two. So that means at some point, do they run out of ammunition? Do they run out of safeguards? And again, there's the 2.2 trillion sitting in reverse repo as a safeguard. So I don't know if you're going to see an instantaneous crash. I think they still have ammo. And of course, all they have to do is say we're going to pause on the hikes, and that will create FOMO by itself. So they're not out of ammo yet, and I do think that they will be able to, manage things somewhat. But yeah, if a certain amount of black swan events all happen at once, then they'll lose control, and then it'll be your guess is as good as mine as how bad it gets, and whether some of those institutions fail. And that's the problem is when you be talking about it, phase 6 is still gradual. A lot of these obligations that are off balance sheets, we don't really know what the true value of that is because they haven't been properly audited by a third party. So as these things sort of come up, I think, oh my God, well, this liability was this, but now it's actually this. And it's oh, we don't have enough capital for that. Oh, so you have fire sales going on. So I think that's what could happen is the unintended consequences because, regulations catching up to the market, and like like people talking about the GameStop thing right now, like Ortex is going berserk because short interest in GameStop is much higher than we thought. There's no volume. We're investigating. Well, my guess, and again, you might even have a better clue than I did, is like, what would happen if there were actually some shorts and swaps that were basically not valued correctly, and now all of a sudden the value of the shorts are a lot larger than they used to be, and like it's like then like that's I think might be what happening. Or Tex is getting new data, and they can't reconcile it with the old data because the phase 6 regulations are causing a third party to audit it correctly as opposed to not correctly as in the past. So I think that is a risk for the market. Is like all of a sudden like, oh, we didn't realize we were this exposed. Oh shit. So that's what I think could happen.
Oh, yeah, and that's why I agree. And that's why I always say what's going to happen next is you're going to see a couple family offices. And this has been my black swan event. I think there's going to be 1 or 2 family offices. That's going to happen after phase 6, that there's going to be, a lot of people don't understand. And I've been, tried to explain with the Citadel and them taking out those 8, ISDA contracts 2 days before was, a lot of these things are grandfathered in. So when these are gone, they're going to be liquidation across the board because they now need to, like you said, there's now a third party saying, nope, we need this collateral this time. You can't just, oh, nope, we're good to go because the bank's got a, credit support annex that says I can afford it, but there's nothing to back it up. That's going to be a massive, massive thing. And who knows when those start, expiring? It could be at any point. So I definitely think phase 6 is doing exactly what I wanted it to do. The next thing, let's see here, 1 second here. So the next, so I did the market crash. All right, so the last one I got here, I got 2 more here. So the last one I got is U.S. home prices have started to fall 2 straight months for the second month. The last decline in last month was the largest decline of 1.3% since 2010. JP Morgan Chase, Wells Fargo, they've hit with all-time record low mortgage applications. Do you see a housing market crash coming or a correction in price? And would the Federal Reserve allow that, seeing as how they have $2.7 trillion in mortgage-backed securities, and that's their biggest asset? Or do you think they don't care about taking losses because they'll just print?
Yeah, on that last point, I agree. Like they don't care. They will basically like bear the cost. So, I mean, again, it's like the interest rate side is different from the financial stability side. The financial stability side is a cost. To make money, providing safeguard for markets can work. Like I said, if you were the Fed and you were buying in equity index futures and you said, okay, we've got like a 12-month horizon on this. We don't care what happens in the next 3 months. So it keeps crashing. We keep buying more. Eventually that position will turn a profit if the market recovers. But in the MBS, again, it's a MBS is a 30-year product. Some of the these mortgages are 30 years. It's like we don't really care what happens in 2 or 3 years because we'll be holding this thing for a long time if we have to. And so they'll do what they have to on the interest rate side, regardless of what happens to the MBSs. But do they care about what's happening to the average homeowner who's getting kicked out of their mortgage because they can't afford it and they're losing their house, and then they have to rent, and then BlackRock or Blackstone or whoever is charging them twice as much as they should be for rent? Do they care about that? And the problem is, I don't think they do initially, because again, the Fed's not the politics side. It's basically who's in power, and that's like, oh, we're going to lose the next midterms because the populace is pissed off because they're homeless. That's an issue. But in the meantime, the Fed is just going to wantonly destroy people's lives, and they don't care. And that's the sad truth of it. And they basically, again, it's like, again, the Klaus Schwab attitude. It's like, yeah, we're going to do what we can to get inflation down, and there'll be collateral damage. And oh well, that's the central bank attitude. And I have to admit, when I was at the Bank of Canada, we, acknowledge that, like, people will make mistakes on mortgages and buy houses that are too big for them, and that's just the buyer beware type thing. And we only can do what we can to create stability in the market. So there is a kind of apathy in decision making when it comes to central banking, and as a result, I don't think they care what happens to homeowners.
Okay, thank you. And then, so do you see a crash coming in the market at all, or a big decline coming soon?
Like in Canada, so they said the Bank of Canada only did 50 yesterday or Wednesday, and the talk was that they saw deterioration in housing market faster than expected. So if you look at like condo sales and housing sales in Toronto, which has like been an overheated market, they are falling like 99% over the last year. So the prices hadn't necessarily come down dramatically yet, but the actual activity is falling. So I think that, yeah, higher interest rates will create some sort of housing crash. The U.S. is not anywhere near the problem it was in 2008. So maybe like a lot of people were able to get financing at low rates, and presumably because of the way the U.S. mortgage system has worked, you buy a 30-year mortgage, so you don't have to worry about reset periods as much unless you get like a ninja loan where you got a teaser. Like that's the problem, is that people get sucked into these. Like, yeah, you can only pay 50 basis points for the first year. Oh, then you pay 700 basis points the year after, whatever. That'll be the problem. I don't know how many people in the U.S. have that, whereas I know a lot of people probably renegotiated the 30-year at all-time low rates. So I'm not too worried about the U.S. homeowner. I am worried about the Canadian homeowners because, again, we don't have that luxury of locking a 30-year rate. We get a 30-year mortgage that's renegotiated every 5 years. So, and a lot of people in Canada don't necessarily negotiate for 5 years. Like I just negotiated one of mine for 3 years. So the reset periods become a problem when you have a very quickly moving interest rate market, and all of a sudden your mortgage is much more expensive. So I don't think U.S. will have a collapse like they did in 2008 unless the Fed goes absolutely bonkers. However, other countries like Canada, yeah, there'll be a significant correction in housing.
Yeah, I agree. And I mean, with Canada, like you were saying too, you have, the Chinese inflated your guys' market so much. And if you guys are doing it every 5 years, I can't even imagine what it ended up costing you guys, It's crazy.
Yeah, absolutely.
So then the last one I got here is, one of the things I always talk about for Black Swan events is us being one. One of the things I always talk, about people being able to do is move to credit unions because of rehypothecation. One of the biggest things that you're seeing with these banks is they're able to take loans. If you can, I know it's not financial advice, but if you can get a better, rate, moving it out of that, because that takes it out of their dark market, their dark banking. It takes it out of that collateral that they once had posted, which means now they would need to open up a new loan, and that would put pressure on the banks. On top of that, if we move out of our accounts, as you guys can see, they showed that the deposits were one of the lowest they've seen in years. Do you believe if we, ourselves to start attacking these banks and their incomes? Another thing that they're doing, they have 930 billion in credit card debt, and they're taking that interest rate, while they're moving those up, they're charging people more, and that's where they're getting a lot of this revenue as well. Do you believe if we start attacking these banks more and putting more pressure on them, or putting more pressure on the feds to use some more of that ammo, it would get us closer to a MOAS? And the last thing is going to be is about the politicians, is putting pressure on politicians to start, bringing awareness to this more and more, and actually, doing things to these bankers instead of bailing them out.
Yeah, I mean the issue is because it's not like, if you have a grassroots movement moving money out of banks into credit unions, it's going to happen over time gradually. It's not going to be all at once. So it can be adjusted for in terms of the banks adjusting their positions. I mean, longer term, it does have an impact. It's like DRS. It's like if someone decides to DRS their shares, okay, it doesn't really affect GameStop that much. If like a whole bunch of people did it at the same time, it would have a bigger impact. Over time, however, even one person doing it every day will eventually have an impact. So that's the same thing with moving to credit unions. It will have an effect on the system if enough people do it. And again, what time frame are we talking about? And that's my only problem with that approach, is like it could it could drag on. Like it doesn't happen instantaneously, and so to get noticed by the banks, it's like, oh well, shit, we're losing clients and we're losing deposits. But it doesn't happen in a big enough way in a short period of time for them to realize that their policies are stupid and they need to change them. And again, the same with the politics. It's like, you try and get some, hey, look at this problem. Oh, how big a problem is it? Well, it could be a big problem 30 years from now, or 20 years from now, or 5 years from now. But 5 years, I only have the term left in me. I'm going to retire, and like I don't care. And that's the problem with politicians. It's like they have this short-term focus, and the problem with North America in general is a short-term focus. So like these are things that could affect things, but trying to get politicians to care when they're, again, working for themselves more than they are for the people they represent, So I'm not trying to poo-poo it at all. I just think it. Unfortunately, I don't think it has a big enough impact in the short time period it needs to have one. So.
Yeah, no, I agree. I mean, we're actually been trying to get people off, payment for order flow platforms, and look how long that's taken. It's been years. They're still on them.
Exactly.
But I mean, I was just trying to think, man, because I mean, at the end of the day, all we can do is give them things we can do to try and make an effect on their collateral and what they have and their revenue. And I mean, what else can we really do other than make our voices heard that way? And the biggest way you get their attention, in my eyes, is their pockets. And on top of that, if you take their collateral, it makes it so they can't bail these guys out as much.
Yeah, I think the biggest point that you've raised in this whole discussion is the pension funds. If enough people get annoyed enough with what's happening with their pensions and how much they've lost, and meanwhile, oh, we're going to bail out the banks again, then that is like Wall Street, Occupy Wall Street, amped by 20, 30 times. Because again, you had there was only a select people that enough cared enough to actually go to Wall Street and protest. I think the meme stock, like, I hate saying that word, but I think retail investors in general are a lot more aware of the corruption that's going on in Wall Street than they have been previously. But they get like Uncle Joe who worked for whatever Maytag for 30 years, and all of a sudden his guaranteed pension is no longer guaranteed, then that's going to get him riled up. So I think the pension issue is probably the biggest hot button topic you can bring up here.
Yeah, and as we see, you already see a couple of those pensions starting to pull out of these funds like BlackRock. So I mean, more people we can make aware of this, or more people we can. That's why I say put pressure on the politicians and things like that, because if they can move their pensions out of those companies, I mean, that would destroy them.
Yeah, absolutely. Yeah, I saw someone. What was it? Sorry,
I think it was Louisiana, wasn't it?
Yeah, I just saw, Illinois is taking $300 million out of a hedge fund, so it is happening. Like, hedge funds are starting to see that, we're not going to be able to retain these pension funds, and the pension funds are a good, stable source of funding for them. Like, it's like pension funds don't normally like panic if they're down 50% because, again, long-term view. But if the pension funds are taking hits on their bonds, then their high risk equity portfolios, going to start caring about those a little bit more. So I think, just keep an eye on pensions, because I think that's going to be the hot topic issue in the U.S. And just to go back to the U.K., Sunak has basically came in and stabilized things. So the U.K. gilt market is stabilized because he said, we're gonna raise taxes and cut spending, and that's what the market needed to hear, and that's the opposite of what Liz Truss was talking about. So that's why she only lasted 30 days or however shortest prime minister tenure on record. But Sunak has already basically said, well, maybe we won't be raising taxes. So he can't even come up with a clear package that's going to be maintained. So the gilt market will probably be under pressure again. And UK pensions will again be under pressure. And the question is whether the UK can keep hiking rates. And I don't know if they can. And so you'll have these high inflation prints. And again, it leads back to the digital dollar issue. So, ultimately, the pension funds are a big piece of this puzzle as to what's going to happen.
No, I agree. And like I said to everybody, keep an eye on UK. What seems to be going on over there seems to be slowly coming over to the United States. That's all the questions I had for you, though. I mean, I appreciate everything. Is there anything else you want to go over? Anything you want to ask me at all?
No. All I can say is just any new updates on Phase 6 or any kind of sign that we're seeing impacts is probably going to help people feel a little more reassured about these places. I said I'm watching GameStop, and like that to me is like there's something odd going on there, because it would be knocked down to 25 every time it got to 27. And I haven't checked in the last hour, but let's see, where is it? 28, 36. So something's changed with GameStop, and it could be this Ortex thing. So, if more short interest is being revealed because Phase 6 is starting to kick in, then that could be good for not just GameStop, but all these short plays. So.
Well, I agree. Like I said, I mean, I haven't been happier about anything other than Phase 6, because for once, it's not just the United States regulators who are corrupt. It's everybody.
Yeah, exactly. I guess, if I'll lead off, I did in my other space call, I mentioned how disgusted I am with the DTCC. I used to think that it was a neutral organization, and now I feel like they're in on the whole scheme. And it's like, driving down Main Street and finding out your drugstore owner was actually dealing crystal meth on the side. That's how I feel about the DTCC right now. So to get other authorities involved makes me pleased, because not all of them are so compromised, I believe. So.
Well, I agree, and I mean, if anybody had faith in the DTCC, the GameStop report should have showed you everything you needed to know.
Exactly.
But thank you so much for your time here, Peter. I got to get back to work here, and I know you're not feeling good, but thank you so much for doing this.